This is a presentation for Chapter 13, Stockholders' Equity. In Learning Objective 6, we're going to explain or discuss how equity is reported for a corporation. So you have studied in your previous Principles 1 class the Statement of Retained Earnings, and it just reports how the company's retained earning balance changed from the beginning of the period to the end of the period. We're going to look at it again in this chapter. So one thing that the author brings up that we don't normally talk about that much is that companies can actually have a negative amount in retained earnings. This is called a deficit, and it can happen either when a company has recurring losses and or they declare dividends in excess of their retained earnings. So most corporations do not operate very long with negative amounts in retained earnings. So if that is the case, they were probably going to be having some type of liquidation, I would think, in the near future. This is an example of the Statement of Retained Earnings for Smart Touch Learning. If this were their very first month of, or at the end of December of 2024, if they just started business on November 1st, then they would have had a zero balance at the beginning of the period. Then we would add to that any net income. So for these 2 months they had $8,550, and then we would subtract any dividends that had been declared, and that would give us the ending retained earnings balance at December 31st, 2024. And you're pretty familiar with this Statement of Retained Earnings from Principles 1. One thing we like to point out to students is that when corporations get loans from companies, financial institutions like banks, and they borrow money from them, the banks want to make sure that the companies do maintain a minimum level of stockholders' equity. In looking at the journal entries that we've covered for Chapter 13, you've seen that both declaring dividends and purchasing treasury stock reduce stockholders' equity. And so many times in the loan agreements or bond indentures, there'll be restrictions placed on the corporation that focus on the balance in retained earnings. So companies are supposed to disclose this information in the notes to the financial statement so that investors know that there is a specific amount or a minimum amount of stockholders' equity that they are required to maintain, and that may affect their ability to be able to issue future dividends. Another aspect about retained earnings is what's called appropriations. So sometimes the board of directors will want to appropriate or set aside a certain amount of retained earnings for some future purpose, and they'll actually make a journal entry where they debit retained earnings and credit appropriated retained earnings. So it just shows the users of the financial statements again that there is a particular part of retained earnings that the board of directors has set aside that would not be available for future dividends. Companies do make mistakes on their financial statements. Sometimes it's due to accounting errors. It can be mathematical mistakes, or it could be that they just didn't understand accounting principles. A lot of times it happens when adjusting entries are overlooked or not made at the end of the period, and a lot of times these are not discovered until after the accounting period is already over. And so we have to figure out how to correct these. So corrections that we make for prior periods are made to the beginning retained earnings balance, and these are called prior period adjustments. So they can be either an increase or a decrease in the beginning balance of retained earnings, and they would be shown on the statement of retained earnings. So this is a hypothetical or company that we're going to look at to illustrate a prior period adjustment. So this company is called Mountain Home Inc. And in the prior period, they had recorded $30,000 of salaries expense for 2024. However, at some point in 2025, they realized that the correct amount of salaries expense was $40,000. So it could be they failed to make an adjusting entry. So the effects of that error was that it understated salaries expense by $10,000. Well, we know that salaries expense would normally be closed to retained earnings, and so the net income would have been overstated by $10,000 and retained earnings would have been overstated by $10,000. So since this error was not discovered until after the books were closed, then the way that we show this to the users of the financial statements is through the statement of retained earnings. So if you notice, we start out at the beginning of the statement saying retained earnings at the beginning of the year, January 1st, 2025, as originally reported. And that was $140,000. Then we show that prior period adjustment. So that $10,000 of salaries expense that we failed to record in 2024 is subtracted, and that gives us our retained earnings at January 1st, 2025 as adjusted. So that is how you show the correction of an error for a period prior to the current period, and it wasn't discovered until that period's income statement and books were already closed. Now we're going to look at, in just a minute, a statement of stockholders' equity. So we talked about a statement of retained earnings, but another option for corporations is to show a statement of stockholders' equity that will actually report all the changes in stockholders' equity from the beginning to the end of the year and not just changes in retained earnings. So as the slide indicates, IFRS actually requires a statement of stockholders' equity. So that is probably one of the reasons why most all corporations now incorporate a statement of stockholders' equity in their financial statements. So this is an example of Mountain Home Inc.'s statement of stockholders' equity. It incorporates the information that we just looked at about the prior period adjustment. And we also see that it shows the balances for the common stock and paid in capital in excess of par, in addition to retained earnings. There weren't any changes in common stock or paid in capital during the year, but if there had been, they could be shown on this statement. But we do see the same information that we looked at in the statement of retained earnings for Mountain Home Inc. So this is just a more comprehensive statement. It shows all of the items in stockholders' equity and in a column format that is usually makes it a little bit easier to combine all of this information together. And that is the conclusion for the presentation on Learning Objective 13.6.